The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Investor Expos show for the 26th of March. Today we are having a great lineup of 4 speakers for you. Michael Valtos, Todd Horwitz, Ray Burchett, and Matthew Buckley. This session will be recorded and sent to your email. Please take a look at your GoToWebinar control panel. Into the questions box, you will be able to ask any questions you want during the speaker's presentation. I would like to begin and bring to the show our first guest,
Unmuted.
Michael Valtos. Welcome. Good morning, Michael.
Hi, Anna. Good morning. How are you?
Pretty good.
Pretty
No
good.
matter what.
Yeah, stay safe, stay strong.
Crazy timing. What have you prepared for us today?
Well, today I'll be talking about, the way the markets have been pretty chaotic recently. So, they seem to be moving around very fast. So I'll be talking about reversals and how to see them in the order flow. And I think it'll be a nice, timely presentation for everybody.
Sounds good to me. I will give screen over to you and get back to you around 8:45 Pacific.
Okay, great. Let me see. Okay, hopefully you can see my screen okay. All right, everybody. Today I'll be talking about order flow and reversal trading. And I feel it's very important in these times, when markets are very chaotic, to sort of have a way to see what's happening in the market very easily with the order flow. And what I'm going to show you is 2 setups that I like to look for in the order flow. They're not fancy setups. You don't need to draw any lines or do any major calculations, nothing like that. Order flow is basically reading what the market is telling you. And if you stick around to the end, I'm going to give you a copy of my book, if you don't already have it, called Trading Order Flow. It's a digital download, so you'll just have to enter your email to get it. So you're not going to be sent a hard copy cover of the book. But before we begin, a brief disclaimer. Please understand that trading is risky. I'm sure everybody understands that by now, the way the markets have sold off quite dramatically in the last month. And, only trade with money you can afford to lose. And those of you that are new to order flow and new to who I am, just a brief description of who I am. My name is Michael Valtos, and I've been in the market since the 1990s. Right? I started on the CME floor as a runner with Dean Witter, and eventually I left the floor when electronic trading started taking off. I joined the upstairs trading desk, and I spent about 3 years total at Dean Witter. Then I left for EDF Man, which is an English trading company, on their global macro desk. After that, I joined Commerzbank, the big German bank, as their Eurex trader. And after that, it was right after 9/11. I left there and took about 6 months off, and just sort of had to find myself again. And I joined Cargill. I was a trading desk manager in Chicago, and eventually I got sent out to Singapore to set up a trading desk there. And after Cargill, I joined JP Morgan, where I spent 8 years as vice president of futures trading. And in 2013, I left JP Morgan, and I just started trading for myself this time. And eventually I started my software company, Orderflows.com. So, when I left JP Morgan, I really wanted to have a contribution to the trading world. So I started writing the book, right, Trading Order Flow. And I was trading for my own account. I was using a software from another company, and it was just basic order flow software, telling you the volume traded on the bid, volume traded on the offer. And I wanted more from the software, right? I wanted the software to show me more of what was happening in the market by doing the analysis that I was doing by hand, doing in my head. And I met with the programmer and I said, what, this is how I analyze the markets, right? Can you put this into the software? So, we started working together, and about 6 months later, we came up with the Orderflows Trader software. And initially, it was just for me. I created it just for my own trading. But then as I showed more and more people, they're saying, hey, can I get a copy of that? And eventually, that's how Orderflows.com was born. And the charts that are used in this presentation are generated from my Orderflows Trader, which runs on NinjaTrader 8. Okay, so I work with a lot of traders in the past, and I've always, they show me their charts, and sometimes it just looks like they're throwing noodles at the wall. There's so many lines. It's just like, they'll be like, well, the market reacted off of this price here, then it reacted here, but it's like there's no sense to it because they got lines pretty much, every 5 points. So sooner or later, like even a broken clock is right twice a day, right? You need some structure in your trading, and order flow, gives a lot of traders structure. Now, I prefer to keep trading as simple as possible. I like to look at price and volume over time or over a range. Most traders only look at price. They don't take into account the volume. Now, if you've ever studied economics or you've run a small business, you'll understand the importance of volume, right? When you do your numbers, whether you're making money or losing money, you're going to check how much you're selling at a certain price, right? You just don't say, well, I sell milk at, $2 a gallon. Well, I sell this amount of milk at $2 a gallon. I sell this amount at $1.90. I sell this much at $2.10. You find the area where you can maximize your profits. That's why volume is important, because it helps you understand the current supply and demand situation. Now, most recently, right, we're all familiar with this, right? The whole panic buying of toilet paper. And, this is pictures I took myself in the grocery stores over time because, I sort of saw this coronavirus thing coming back in January because I had my sister-in-law from Asia was here, and she was trying to get her flight back to um, Asia, back to the Philippines, and she was having a hard time changing it because she didn't want to travel through Shanghai. Then I just sort of noticed, what was happening. People were starting to buy stuff. Well, all of a sudden now demand was hitting the market for toilet paper, right? But the price of toilet paper was consistent, but the demand was outsized. Everyone was buying it. But if everyone is buying, what do you think is going to happen? Well, it's going to eventually all the volume, the amount of toilet paper is going to be gone if demand, if price is steady, but demand is still there. Now, another good example, right? I have 3 kids. I buy a lot of anti-bac soft soap, okay? And normally I could go to Walmart and buy it for $3.97 for a 50-ounce container, right? And I usually keep, 3 or 4 anyway in the house because, I'll buy it when there's a coupon in the paper for $1 off. But now you can't even buy it at Walmart. You go to eBay, it's $30, right? So it's the supply and demand. Now personally, I think, these people that are price gouging, should be getting a knock on the door from the authorities. But that's a perfect example of supply and demand, right? And you can see how it applies in the grocery business, but the same thing applies in the markets, right? Markets go up on increased demand. Markets will go down on increased supply. When supply and demand are equal, soft soap is $3.97. When supply is limited but demand is high, soft soap is now $30. But how does this apply to you as a trader, right? If you can spot an area where very aggressive buyers are stepping in at low prices, people coming in buying all the soft soap, people buying all the toilet paper, that's your opportunity to get in and buy, right? Or we haven't seen this in the grocery store, but very aggressive sellers coming in and selling at high prices. But you're seeing it at eBay, not so much on Amazon anymore. People, they got a lot of soft soap, they got a lot of supply, they're offering it out there at $30. People go, hey, I'll bid $30. They hit those bids. So how can you tell if aggressive traders are especially active? Is you're going to look for imbalances in the market. Now, to look for a market imbalance, you need to look at the volume that's being traded. And this is, we know that the market trades in a two-way auction, right? There's a bid price, there's an offer price. There's a quantity on the bid, there's a quantity on the offer. Okay, so if the market is currently 29.55 and a quarter bid, offered at 55 and a half, size of 72 by 196. For the market to tick up, someone has to buy the 55 and a halves. For the market to start ticking down, someone has to start selling the 55 and a quarters. Once they sell all the 55 and a quarters, the next bid is 55. Once people sell those out, the next bid is 54 and 3/4. Now, once you understand that the markets move in a two-way auction, you have to understand there's 2 types of traders and their activities. And depending on your trading style and order type, you are one or the other. Now, a passive trader is a trader who tries to buy on the bid or sell on the offer. They wait for the market to come to them. Okay, so if you are trading the market, you put a bid in the market, whether it's on the current bid or it's $5 lower, you're considered a passive trader. You're waiting for the market to come to you. If you get filled, great. If you don't, it's not the end of the world. Now, an aggressive trader is someone that doesn't wait for the market to come to them. They trade at the market. They sell into the bid or buy the offer. They do a market order basically. So they see the market is offered at 55 3/4. They buy the 55 3/4. They want to get in the market. They want to get in now. And an imbalance occurs when in the two-way auction, you compare the volume that was traded on the bid versus the volume that was traded on the offer. If the volume traded on the offer is greater than the volume traded on the bid by 4-to-1, again, 4-to-1 is a guideline. Some people use 3-to-1, other people use 10-to-1, but most traders prefer 4-to-1. You would consider that a buying imbalance and vice versa for a selling imbalance. So if the volume traded on the bid versus the volume traded on the offer is 4 times more volume traded on the bid, meaning you got 4 times as many traders selling at the market, selling into the bid as opposed to buying the offer, then you would have a selling imbalance. You have more aggressive sellers. So how can you see it? Well, some people say, well, I see traders, they like to put up the time and sales window on their screen. And honestly, the way the market moves is it's so fast. This is last night. This is about 8:15, just before 8:15 p.m. And you can see, it's a lot of ones and basically a lot of ones. This is NASDAQ, right? Every trade that was going through is basically a one lot. And if you're trying to, make sense of this, imagine during the day, it is moving so fast you can't keep up with it. Now, other traders, they like to look at a DOM, okay, the price ladder, and see, the volume traded on the bid, volume traded on the offer. The problem is the DOM moves very fast under normal market conditions. And when I say normal market conditions, I'm talking about, when a VIX is, below 10. If you're watching the NASDAQ DOM during the day, you're talking about a market that is, 2-3 points wide, not 2 or 3 ticks, 2 or 3 points. And it's moving so fast up and down, you can't keep track. S&Ps is a little bit more stable. Crude oil is a bit stable. Eurocurrency is also generally a bit stable. So again, it depends on the market. But to watch a DOM, you got to know what to look for. And honestly, trying to interpret the DOM or the time and sales, is like, you got to be like Rain Man or the guy in Hangover, right? You got to do all these quick calculations in your head. But, what I want to show with you, what I want to share with you is the easier way to watch order flow, and that's called the footprint chart. Okay, and you can see the imbalances on a footprint chart because it'll be highlighted to you, okay, after it happens. You don't have to be trying to catch up with the DOM, staring at the DOM intently that, if you look away for a split second, you miss something, right? At least the footprint chart keeps it all in a nice, easy to read format. The selling imbalances will be the red numbers inside of a bar. The blue numbers would be a buying imbalance inside the bar. And what you see on a footprint chart is you see the volume at each price level, what was traded on the bid, what was traded on the offer. Now remember, it's a two-way auction, so you're going to compare it diagonally, not horizontally. And you're going to be looking for those areas of the imbalances. The imbalances measure the two-way auction and looking for imbalances between what was traded on the bid versus what was traded on the offer. So, imagine taking all the data you see going through on a time and sales window. If you don't believe me, open up a time and sales window on your trading system and see if you can make heads or tails of it. It's just going to give you a headache. Take a look at the DOM, okay? And if you've watched the DOM for long enough, you know that if you get up to go grab a drink in the refrigerator, come back, you missed all that information. It's gone, right? You're not going to see it again. But the footprint chart puts it into an easy to read format that allows you to make quick and easy trading decisions. And you're not going to see any of that information on a bar chart. Now, there's a lot of information. A lot of people get scared when they look at an order flows chart the first time because they see a lot of numbers. People are scared of numbers. But believe me, there's nothing to be scared of. In fact, once you understand what the numbers are that you're looking at, it just makes perfect sense. It's a nice addition to everybody's way of trading. So this is an E-mini 1-minute chart, and each bar, it's a 30-second chart, and you can see the volume traded in each bar. You can see where there are imbalances, where there's support and resistance, where there's aggressive buyers. You can see the delta, which is the difference between net buyers and sellers in a bar. I'm not going to be talking about that today, but that helps you determine when there's shifts in supply and demand. Point of control. Each bar has a point of control. It's the volume level, it's the price level with the most volume, and there's going to be times where it acts as support and resistance. And imbalances, right? It's the volume in a bar in the two-way auction, where the volume traded on the bid versus the offer is greater than 4-to-1. Now, when I try to explain order flow to people, the easiest way to describe it is like this. Imagine playing poker, but being able to see the cards of the other players, right? When you're looking at a footprint chart, you're seeing what everybody else in the market has just done in the market. You can see, if people bought at bad prices, if people sold at bad prices, if someone's defending a price area. And that's very important information. If you're looking at a normal bar chart, you're not going to see that information. Okay, so this was yesterday in the E-minis. This is a 30-second bar candlestick chart. I would show a 1-minute chart. People say, why are you looking at 30 seconds and not 1 minute? Well, honestly, the market's so volatile recently that looking at a 1-minute chart is kind of difficult because there's just so much information going through so fast. I just take it down a level. I look at a 30-second chart. But you can see, right, there's 3 potential reversal areas, number 1, number 2, number 3. You got the red candle, anytime the market is going up, then you get a red candle, a bar closing lower than where it opened. It's a potential reversal. All right, so you got 1, 2, and 3. 1 didn't really work out. It sold off a little bit. Number 2 just went sideways. Number 3, you had the nice 30-point sell-off. But if you're looking at 1, 2, and 3, I know some people would sell number 1. I know some people that would sell number 2. I know some people that would sell number 3. But if you're looking at the order flow, you wouldn't sell number 1. You wouldn't sell number 2. You would sell number 3. Okay, and how can you determine that? Is because you're going to be looking at the imbalances in the bar. Are there aggressive sellers coming into the market? So on number 1, this is number 1 on the footprint chart. You don't see any selling imbalances, right? You see no red numbers in the bar. Number 2, you see 1 selling imbalance. Okay, that's good, but that's it, right? But if you look at number 3, you've got 3 selling imbalances, right? And with order flow, 3 is sort of like the magic number that a lot of traders look for in terms of imbalances or stacked imbalances, right? And you can see you got a swing high, right? Just as 2 and 1 were swing highs, but you don't have the aggressive selling coming in. In bar number 3, right, you've got 1, 2, 3 selling imbalances. Now my software, like I said earlier, right, I created my software to help me see things in the order flow that I might otherwise miss. My software will put a pink box around a bar that has 3 or more selling imbalances for a down candle, a red candle, or 3 or more buying imbalances for a green candle. Now, this differs than your normal stacked imbalance where you have 3 or more buying imbalances stacked neatly on top of each other. That's what this green area is. Or a stacked selling imbalance, which you see here on this red candle in the middle, 3 or more selling imbalances stacked neatly on top of each other. But what I'm saying is when you have 3 or more imbalances in a bar, that is still important, right? And it's important to notice when it happens. If you're just looking for stacked imbalances, you're going to miss the bars that have 3 or more imbalances in them as well. And why is that important? Well, as you can see on the bar, on the high, you've got 3 imbalances. 2 of them are stacked neatly on top of each other. Then there's 1 that's not a selling imbalance. It's 26 against 67. And then you have another selling imbalance. So, it's just 1 price level away from being a stacked selling imbalance. But if you're just looking for stacked imbalances, you're going to miss this. That's why our software will put a box around the square, box around the candle. So, just going back, number 1 has no selling imbalances. Number 2 has 1 selling imbalance, but it's number 3 that has the 3 selling imbalances right there on the top at your swing high. Okay, so going back to your candlestick chart, can you see the imbalances? No, you can't. You don't see imbalances at all if you're just looking at a normal candlestick chart. Now, let's start moving into reversals, right? Simple rules, right? In order to trade a reversal, there needs to be a clear directional move. Sometimes people start looking for reverses when the market hasn't really rallied or sold off. In my opinion, you need a clear directional move, right? And you need to have hit a swing high or a swing low and the market to start turning, right? The market to start trading down off that high or start rallying up off that low. Then you're going to start looking internally into the bar at supply and demand. And how you're going to see that is you're going to see the imbalances. Are people coming into the market to buy off a low or come into the market to sell off that high, right? And so you're going to be looking in the bar for buying imbalances. You're going to be looking for blue numbers inside the bar or red numbers for selling imbalances inside the bar. Now, there's going to be 2 types of reversals I'm going to discuss now, and they're easy to spot in the order flow. So the first type is aggressive traders coming in at a swing high or swing low. Second type is trap traders, basically when a breakdown or breakout fails. Both are easy to spot simply by looking at imbalances in the order flow. Okay, so for the first type of reversal I'm going to share with you is the aggressive traders coming in at swing highs or swing lows. And there's 2 criteria I require for this trade. Number 1 is a clear swing high or clear swing low. Not a bar before or after the swing high or low is made. No, that bar has to be the low, the swing low, and preferably I like it to be the low by, a few price levels, right? So if the previous bar, the low was 7, then our new swing low, the bar is got to be like 5 preferably, or 4 or 3. It's got to be much lower, not much lower, but a little bit lower. And I want to see multiple 3 or more buying imbalances for a buy at a swing low. So I want to see at least at 3 price levels, I want to see aggressive buying appear, right? And for a sell, I want to see multiple selling imbalances coming in after the swing high is made in the bar when you made the swing high. So I want you to see the bar make a swing high, then all of a sudden I want to see sellers attracted to that high and come in and start selling it. I want to start seeing 3 or more selling imbalances in that bar. So I'm going to show you a bunch of different charts. Okay, I'm going to show you E-minis, crude, Eurocurrency, and Bunds. Now, so many people trade on so many different types of charts. If I don't cover your chart, I apologize, but there's only so many different ways you could look at the market. So I'm going to show you like E-mini 5,000 volume. I'm going to show you 30-second, 1 minute. Some of the other markets, I'm going to show you 5 minutes and even 15 minutes. People always ask, can I use order flow on a 15-minute chart? So this is an E-mini 5,000 volume chart. And again, this was last night, or the night before rather. And again, it's a 5,000 volume chart. So it's not constricted by time, it's constricted by volume. But what I'm looking for, like I got the arrows here, right? You got your swing low, clear swing low, much lower than the previous bar, but you're seeing buying imbalances coming in here, right? It's got the pink box around the green candle, right? You got 1, 2, 3, 4, 5, 6 imbalances here on this first low, right? And then the next bar straight up, next bar higher, next bar higher. Again, it doesn't look like much, and granted this market's been pretty volatile, but it's essentially a move from around the 2412 area up into, the 2430 area. Then a little bit later, you made a new low, right? And then what do you have? You've got about 8 buying imbalances coming in after that low is made. And then the next bar goes literally from 04 all the way up to, 28. And again, in this type of market, you really want to get in and out as fast as you can, limit your risk. You want to be looking for quick trades, and if the next bar, oftentimes you see these next bars just explode on you in the direction that you want to be, positioned in. So here's a swing high, also a 5,000 volume chart. Again, you hit your swing high, you've got 7 selling imbalances coming in. Market has a nice sell-off, right? Here's a swing low. Market in the next bar didn't go higher than the first bar. It just went sideways for 2 bars. You made a new low by 2 ticks before it exploded again to the upside, about a 30-point move there. Now, people always ask me, where would I put my stop? Normally, I put my stop below the low of the signal bar. And normally, I wait for the next bar to open up and start trading higher before taking a trade. So this one is, I wouldn't take the trade because we didn't make that move initially, right? I like the market to start moving in my direction faster. But, if you're one that just, people like to automate things and take every single trade, I prefer to read the order flow because it's going to benefit you over time. If you get long and then the market puts in a red candle and tests the low, that's probably not a good sign. Here you did break the low by 2 ticks before turning around and rallying. But in this market environment, having tight stops sometimes is just going to stop you out. Now, this is not a buy or a sell, okay? And why not? Because this is not a clear, this red bar, right, for getting short, it's not a swing high. Just as this bar for getting long, it's not a swing low, okay? That's the criteria. That's why people will say, well, I'm looking for a reversal. So this red bar is the swing low, and then the next bar starts coming up. Yeah, I see that, but that doesn't meet the criteria, right? If I'm looking for a reversal bar, this is not a reversal bar, right? Just as this other one is not a reversal bar. Instead, it's an inside bar, and you're not even at a swing high in the bar before it. That's why, I hate to say you got to follow the rules, but, the rules are there to qualify what you're looking at in the market. So another example, right? This one, this is a nice swing high, okay? It's high of the day. But what happened? Did the market sell off? No, it just went sideways, okay? Sometimes the best trading ideas don't work out. It just went sideways. Okay, that happens in trading. This is a nicer one. This is a clear low, even though it's just sort of been going sideways, 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 but you did break and make a nice clear low. Then you got your multiple buying imbalances, and then the next bar rallies, 10 points. Now, excuse me, this is a 30-second chart. Okay, so, I have the arrow here at this swing low, right? You got your buying imbalances, market made a nice rally. Now, people say, Mike, what about this other one here? Okay, it's a double bottom. The first candle down, and then the second candle up. They got to share the same bottom. For a reversal, I wouldn't at this point really consider that a reversal, even though this one had a nice little move before coming down and sort of testing the bottom again and making the big move. This is borderline, right? The first one here with no arrow, where you have the green bar next to the red bar. But the second one is clear. I like clear trading signals. Now, here's one. It just went sideways again, made a new high by a couple of ticks, and then had the nice sell-off. Again, here you have a double top where it didn't get the sell-off. But, these things happen. Even if you sold this, right, you get stopped out here, you got another signal to get short. Hopefully you could have caught that one. Now, this is a 30-second chart again, right? Clear high, multiple imbalances, 1, 2, 3. A nice sell-off from, the 80s down into the 70s over the next several bars. All right, so 1 minute crude chart. Okay, nice clear swing high, multiple selling imbalances at the bottom of the bar. Doesn't look like much, but this is about a 20-cent sell-off in the next bar. Market then just goes sideways on you before it starts drifting down again. So you're seeing it on 30-second chart, 1 minute chart, crude oil chart, E-mini chart, Eurocurrency chart, 1 minute chart. Your new high of the day, multiple selling imbalances, market sells off, about 20 ticks. Eurocurrency, 5 minute chart this time. Okay, so you're expanding your time horizon. There's your multiple selling imbalances at the high. The market sells off from the 109.20 area down below 108.80. Another 5-minute chart. Again, your clear high, multiple selling imbalances. Next bar, from the 108.95 area, just in the next bar to the 108.75 area, 20 ticks in one bar. Okay, this is also a 5-minute chart. Some of these charts, honestly, they start to look alike because you're seeing the same things happen over and over and over in the market. Here's a 5-minute chart of the Eurocurrency. A sell at the swing high, 108.20, goes down to the 107.80s. And then you got a buy signal over here at the swing low. Again, and the market goes up from the 108, 05, 010 area over the next bar in the same bar to the 108.25, and then a couple bars later to new highs. Now, the next chart, people always ask me, hey, can I use order flow on longer term charts? Personally, I don't, but I know some people that do, right? And that's why I'm sharing this method with you of looking for these multiple imbalances. You're not going to see them very often on longer term charts, but this is a crude oil 15-minute chart. You got your nice swing high here, rally up off the low, got a swing high. I had to scrunch it, so you're not seeing the numbers, but I know there's a box around the bar, so I know I got multiple selling imbalances. Market started to sell off. We're trading around 24.90. And then it just goes a little bit sideways, and then boom, you get at 130 you get the big bar that breaks from 24.80 down to 22.80, a $2 move right here. But it was signaled right here in this bar with the multiple selling imbalances. This is a 5-year note. This is a 15-minute chart. This is your low of the day. Coming up off your low of the day, aggressive buyers are coming in. Now, in some of my courses, I talk about reading the actual numbers in here. There's something very bullish in this bar with the divergence, with the ratio, with the 0 print, with the 1 print in there. That's also very bullish. But you went from basically your low of the day all the way back up to the highs of the day. Okay, it's a 15-minute chart. So, can you use it on 15-minute charts? Yes, you can. I think that if you're going to watch 15-minute charts, you need to expand what you're looking at. You can't look at one or two markets because you're not going to get very many signals. Some days you may get no signals on a 15-minute chart. Now this is a Bund, a German Bund 5-minute chart for you guys in Europe. All right, your high of the day, multiple selling imbalances coming in, and you got a nice 50 tick sell off here. Again, that's on a 5-minute chart. Another 5-minute chart. From your low of the day, you got your multiple buying imbalances to your high of the day, multiple selling imbalances, and then you sell off from your high of the day. I mean, it appears over and over and over. So we'll Bund a 1-minute chart. Okay, your low of the day, market gradually works higher. It's not a big dramatic rally up, but after a big sharp move down, sometimes the market's going to struggle to put in a rally in, but at least it's going in the right direction. So that is the first one. So hopefully by now you can see how easy it is to spot potential market reversals by looking at the order flow, right? I didn't make any calculations other than seeing what the volume was traded on the bid versus the volume traded on the offer. I didn't have to draw any squiggly lines. If you're not using my software, you just have to look at your chart and see, do I see 3 or more imbalances in the bar? I think my chart is nicer in that it will highlight it to you. I like to keep my charts nice and clean, right? And that's the whole point of trading is with order flow is to keep it clean, right? Understand what's happening in the market and apply that. So the second one that I'll talk about today is the trap traders. Now, what's a trap trader? It's a term you hear a lot of people use nowadays. It's basically someone who's long and wrong, bought at the high of a move, or short in the hole, which is someone who's sold at the low of the move. Basically, when traders get in at bad levels, we've all done that. We've all bought the high of the move. We all sold the low of a move. We all sold the low, and then we cover at the high. Unfortunately, that happens to me sometimes, but that's trading. Now, in order flow analysis, right, when you have 3 or more imbalances stacked on top of each other, that's called a stacked imbalance. Right? I explained that a little earlier. And normally, when you have 3 stacked buying imbalances, they appear in a green up candle, right? Because you have aggressive buying as the market is moving prices up. Conversely, when you see stacked selling imbalances, you see them in red down candles because aggressive sellers are active, okay? So for example, right, as the market's moving down, you see red candles with stacked selling imbalances. You see green candles as the market is starting to go up with stacked buying imbalances. Now, what I want to show you is what happens when the opposite happens, right? When you have stacked selling imbalances in a green up candle, right? When you have stacked buying imbalances in a red down candle. That is a result of trap traders. Traders who are late to the party, so to speak. They get in the market at bad levels. Usually it's because they don't understand the context and market structure or just plain FOMO, right? Fear of missing out. Oh, the market's rallying, I got to buy. Market's selling off, I got to sell. Or I can't take any more heat on this trade, I got to get out. They buy the high. I can't take any more heat on this long trade. They get out, they sell the low. That happens. And often this happens at market turning points. Why? Is because the last group of aggressive buyers or sellers has come to the market. There's a saying, someone has to buy the high. And, you know, for older generation traders, when there was still, people still read the newspaper, there was a saying, right? I made print. And what that would mean is if you bought the high or the low of the day, that's going to be printed in the newspaper because, the newspaper would show the open, high, low, close prices. So if you bought the high, you'd say, hey, I made the paper, I made the print. That was buying the high or selling the low. So for example, right, here's a market. This is E-mini's 1000 tick chart now. Market's going up. You can't really see it on this edge here, but you have a red candle at this swing high. It's like a double top, but you got big buying imbalances. I got another chart here. I'll show you. It's a little clearer. It's the same one, right? You got the big buying imbalances. Then the market sold off, right? A nice 20-point sell-off, right? What's happening here is, again, the market was going up, started to come off. All of a sudden, a big trader or a bunch of little traders came in. I got to buy. Market's going up. I got to buy. Well, what happened is the supply and demand paradigm shifted in this bar. Those guys got long, but at the same time they're getting long, all the big sellers are taking this opportunity to get short at these high prices, and then the market sold off, right? These guys here are trapped. Now, people would have you believe that trap traders are like a big quantity of traders. Often it's a small quantity, but you're going to see it in the imbalances. And that's why looking at the order flow is going to give you an advantage over other traders that are not looking at order flow. So it's a 30-second E-mini chart. 30-second, in this market environment, 30-second versus a 1-minute chart is much better. If you're still looking at a 1-minute chart, I should try and take it down a little bit because most people can't handle that much heat. Most intraday traders aren't going to, on a 1-minute chart, you're looking at price movements sometimes of, $500. By taking it down on a shorter time frame, at least you're sort of limiting that exposure a bit. You can get in and out a lot quicker. So here you have a market rallied up, right? You're coming up here, making new highs. All of a sudden, oh, I got to buy, right? And these guys get aggressive. They buy their 150 contracts, but at the same time, they realize that it's time to buy. All the major sellers, all the people with supply are thinking, hey, this is nice high price. I got to start selling. These are the people with soft soap sitting in their basement ready to sell, because price is high. I could sell it now, make a nice profit. What happens? Market sells off over the next 5 bars. And again, a lot of these charts, they look eerily similar because this pattern repeats over and over in the markets, right? Honestly, before all the volatility exploded in the markets, you'd see this mainly on the more volatile markets like DAX, like NASDAQ, even mini Dow, occasionally in crude. But now you're seeing it in E-minis, partly because of the extreme volatility that we've been experiencing the last few months, the last few weeks. Again, market rallies up. People, oh my gosh, I got to get long. Market's rallying. I don't want to miss this rally. They buy it here. Wrong. Market starts selling off. Boom. Again, another 15, 20-point sell-off on a 30-second chart. It's a 5-minute Eurocurrency chart. Okay, market is sort of going back and forth, starts coming down. Oh, we broke our low. You know, a lot of these price action traders, we broke this low, you gotta get short. All of a sudden, so they get short. What happens? At the same time they're getting short, you know, the bigger traders are realizing this is my buying opportunity. You know, people say, well, that's a stop run. No, it's just people getting short at bad prices because they don't understand what's happening in the market. Market makes a nice rally up, right? Even up here, I don't have the arrow, but you got buying imbalances in this red candle, right? Now, normally I would prefer this red candle to be a swing high, but it's still important. I'm still looking at it because it's not what you expect to see, right? What's happening? You made this new high. Market came off a little bit. Next bar opens up. You start trading a little bit higher. Aggressive seller, big passive sellers came in offering it out, but it's met by the aggressive buyers. You got that buying imbalance, but the aggressive buyers ran out the bullets, right? They got no more left to buy, no more power to buy, but the aggressive sellers got a lot of supply. Market sells off. Same thing here. Crude 1 minute chart came down, test this low, boom. Trap traders start going up, more trap traders. Market makes a nice 50-cent rally. And moving on, again, understand context, right? Here you have trap traders, but we're on a move up already, right? You want to see, if you're looking to buy, you know, where people are going to be trapped, it's going to be at lows, right? If you're going to be looking at a swing high, you're not going to be looking for trap buyers, or sorry, trap sellers. You're going to be looking for trap buyers, right? So this is an example of a trade not to take, right? You got to understand market context. Now here's one, you know, 30-second chart. It just went sideways. You know, you can say it failed because honestly, if trade's not working out after a couple bars, you get out, right? So you could get out at a small loss. You don't have to be married to it. 30-second crude oil chart, again, just sort of went sideways, didn't really sell off, you know, but that's what happens. So don't make trading more complicated than it needs to be, right? You want to get from point A to point B as fast as possible, right? And unfortunately, a lot of people take a lot of sidetracks. So hopefully by now you can see how just using imbalances, right? And there's so many other parts of order flow that you can use, but just imbalances give you amazing trading opportunities, right? You just need to know what to look for, and it does help to have software that has the ability to highlight it to you. So if you're interested in my software, right, the software that we use to generate these charts, go to orderflows.com/oft2.html, and I got a special price, okay? And this is just for this weekend. It's a one-time price of just $6.75. Normally the software by itself is $8.99, but I'm also including my order flow trading course as well as my order flow inner circle video series, which is an additional about 50 hours of training. There's about 56 courses in there. And for this weekend until Sunday night, you can be able to get it for just $6.75. Now there's no additional, you know, indicators like the pulse or the turns. This is for people that really want to get started in order flow and a good footprint chart. So just go to orderflows.com/oft2. Takes you to this page. Just scroll down to the bottom. Here's the button. You can see the price there. You click on the button. It takes you to PayPal, right? I don't get your information, nothing like that. It's processed by PayPal. Now, if you're interested in my book, you can go to orderflows.com/book. You can download it. You just have to enter your name and email and hit submit, right? It'll take you to the digital download page, okay? So, you know, I'm not going to email it to you afterwards. It appears after you enter your email. So go to orderflows.com/book to get my book. If you want to get the software, go to orderflows.com/oft2.html. Now, again, this is a special for new users, right? I know, again, we're in a time of crisis. A lot of people are losing their jobs. I lowered the price specifically for new users. So again, this is just a very limited time. So anybody that's interested, you know, now is the time to get it. You know, we're all on lockdown and you got a lot of time to study the markets. So Anna, thanks for having me. I think I ran out of time for questions, but if anybody's got a question, you know, just send me an email. It's Mike.
Thank you so much, Michael. You can take 2 to 3 minutes to look for any questions that you might miss.
Let me see if I could see anything.
Very generous offer, by the way. Thank you
Yeah,
so much. Love your presence.
thanks. Well, some of these questions, I don't really have time to get into them right now because a lot of them is like, can you comment on this market, comment on that market? But I tell you what, if anybody's got any question, I don't want to take anybody else's time. Just shoot me an email. It's mike@orderflows.com, and I'll try to get back to you as quickly as possible.
Alrighty, by the way, I would like to announce that this Saturday at 10 a.m. Pacific, we are having with Michael a big event, one speaker event. So Michael would have a lot of time to answer your questions.
Yeah, be sure to join that. It's going to be a nice long one. I'm going to cover a lot of stuff that I haven't covered today or in any of the recent webinars that we've done.
Okay, thank you so much, and
Thanks,
see you
Anna.
on Saturday.
All right, bye-bye.